Happy October from John Giordani, Chief Investment Officer of Planning Solutions Group. As markets continue to be volatile, it's a good time for the market update. This presentation highlights recent market events and discusses potential investor action steps, opportunities, and portfolio positioning. The summer was pretty eventful. Global economies and markets are more intertwined than ever. Investors can move between asset classes much easier, which has amplified price swings. Weakening commodity prices, including a double-dip bear market in oil prices, ushered in the summer. As Chinese economic data continued to be soft, this led to more selling of emerging market and cyclical-based assets. The Chinese stock market was the first to crash this summer. Weak trade data led China to devalue their main currency to make their products more competitive versus those of foreign competitors. Anxiety built up in the U.S. stock market, and on August 24th, U.S. stocks crashed. The downside selling was magnified as the use of computer-based trading and trend-following strategies have become popular. In addition, investors have piled into index and exchange-traded funds which are designed to track an underlying index. Many of these investments failed investors as their underlying prices significantly disconnected from the basket of underlying investments that they were designed to track. Our Federal Reserve has not helped this situation as they have failed to communicate that they have a credible policy on the path of expected interest rate hikes. Lastly, the ever-so-hot biotech sector saw many of its stocks crash in late September as politicians began questioning how several companies are pricing their drugs. A lot to digest, and many investors have been lulled into complacency after years of straight-up markets. Let's see what this has done to asset prices. Happily, I say goodbye to the third quarter as pretty much every asset class has seen prices materially pull back. After posting positive returns earlier this year, both U.S. and international stocks are now down mid-single digits as of quarter end. China's slowing economy and too much supply of stuff around the world continues to hit commodity-based assets. The commodity sector is now several years into a bear market, which has wiped out nearly 10 years of returns. Interestingly, one of the most hated asset classes coming into 2015 has done the best. Core bond and fixed income holdings have served as a buffer to the storm and have earned positive returns. This is one of the reasons as to why we own bonds in portfolios. In addition, if riskier holdings sell off more, bonds give you a pot to sell and reposition the proceeds into those underperforming asset classes. Let's keep in mind that while sell-offs are scary, they are common. During the past 5 years, U.S. stocks have experienced 6 times where they have pulled back close to 6% or more. 4 of these corrections had a pullback of 10% or more. As we will discuss later in the presentation, while the S&P 500 stock market index has pulled back 12.5% this year, many stocks are in a bear market, meaning they have declined over 20% from 52-week high prices. Investors are wondering what to do now. Maybe we should start by looking at what not to do. Don't try and time the markets. Sure, there are times when valuations are so expensive that you may not want to invest in an asset class, like tech stocks in 2000, but in 20 years of doing this, I haven't found someone who can consistently move in and out of markets and be successful. When you make a market timing decision, you need to get 2 parts right. Getting out is easy, but when do you get back in? Most of the time, investors get back in when it feels right. That is when markets are higher than when they sold. Highlighted at right is a study from Oppenheimer Funds and Morningstar that looks at the last 20 years of stock market returns. Notice if one ignored the news and remained fully invested, the index earned slightly over 8%. If one missed the 10 best days over the last 20 years, market returns are cut by close to half. Missing the 20 best days, and one likely would have been better staying in cash. When volatility hits the markets, we find it's best to continue to stick with what has worked throughout many market cycles. Do not panic by allowing fear to drive decisions. The news is terrible. Tune it out. I love this quote at Right by Mark Twain. There's always bad news somewhere, it's just magnified when it hits the stock market and one's wallet. We always are concerned with potential downside risk in the portfolio. Knowing how much in potential losses are in the portfolio helps investors to keep emotions out of the investment process. Most of our clients are familiar with this process. Even with significant price declines, we are not seeing events that are outside of our expectations. At right is a chart depicting return scenarios under various portfolio allocations. First, let's look at an allocation of 100% invested in the U.S. stock market. There have been periods where this allocation lost over 40% in a calendar year. So to have this allocation, one must be comfortable with losses of this magnitude. Flipping to the other extreme, a safety portfolio with 100% invested in the bond market would lower your losses to a worst 1 year of only a couple percent. However, upside is also limited over a full market cycle, especially based on where interest rates are now. Having a more diversified portfolio, owning different asset classes may be more appealing. Yes, it has downside as well, but less than half of the stock market based on history over the past 10 years. The upside was nearly as much as being 100% in the stock market. We believe this scenario-based analysis, while not perfect, does help keep emotions in check and help one to focus on full market cycles and not the news of the day. Another item to do as an investor in down markets is to take tax losses. One can maintain market exposure, but put a tax loss on the personal balance sheet and use it later to either offset future gains or to use against a portion of income. Lastly, use the down markets to look for opportunities and rebalance the overall portfolio mix. More on this in the following slides. We did cover a lot on this slide, so please contact us if you have any questions. Let's look at some asset classes and potential opportunities. First, the fixed income or bond market. Our long-term thesis has been a theme of lower for longer. For 6 years, we have heard many sound the alarm about how higher interest rates were right around the corner. We did not share this belief, as in our opinion, global growth would remain weak and economies could not support higher interest rates. The consensus opinion for this year again was that our Federal Reserve would raise rates. It now looks like a rate hike may have been pushed out until next year. Even if the Fed raises rates, they are telegraphing that future interest rates will likely be much lower than the long-term average, hence lower for longer. One sector of the fixed income market that has been hit hard is the high-yield bond space. At right is shown the spread of high-yield bonds versus treasuries. The spread is now at 7.1%, which is above the long-term average of 5.9%. Investors are being compensated much more for investing in riskier bonds than they have been for over 3 years. This looks interesting to us and many of the fixed income asset managers that we talk to. We aren't ready to jump with both feet into this area due to the market risks, but opportunities are beginning to emerge. Professional credit analysis is imperative with high-yield bonds to evaluate the underlying fundamentals of the companies, especially since so many of the companies could face distress in down markets. For example, the energy sector is currently experiencing significant weakness. Low energy prices are negatively impacting the financials and operations of many energy companies. We have seen bankruptcies spike in this sector and expect this trend to continue. Moving over to the U.S. stock market, earlier we discussed the recent correction in U.S. stocks. Yet a majority of companies are down significantly more than the overall market, as shown in the chart here. 60% of U.S. stocks in the S&P 500 are down 15% or more from their 52-week high prices, while over 43% are in a bear market as their prices are down over 20%. When you see sell-offs of this magnitude, the likelihood that the baby has been thrown out with the bathwater rises. This type of action may present opportunities. We use the market crash to slightly increase exposure to U.S. stocks for many portfolios. Should this sell-off deepen, we will adjust portfolios accordingly. As we have previously highlighted in our market updates, we believe international equities are attractive on a relative basis. European economies aren't going gangbusters, but we are seeing a number of positives. Growth is returning, confidence is higher, and private sector loan growth also looks better. A weak euro currency should benefit exporters and help their earnings recover. In addition, at Right, we highlight data from Bloomberg that compares expected revenue and earnings for both U.S. and European countries. For 2015, expected revenue growth for European companies in two market indices are shown in purple and red. Revenue growth is expected to be much higher for them than the revenue growth for companies in the United States. The same holds true for expected earnings growth. If stock prices follow earnings growth, then European stocks may shine again. We have covered a lot this quarter, but let's summarize. One of our core themes this year was expect volatility to jump. Markets certainly haven't disappointed. As uncertainty remains high and we are ramping up into the election season, expect prices to continue to remain volatile. As an investor, stick to your plan. It has been developed and put into place ahead of time so that your behavior doesn't take over and negatively impact your portfolio. We continue to favor high-quality stocks that pay income over speculative companies. We believe that income continues to be an important source of return for investors. Established companies that pay dividends have weathered the storms before, and they will likely continue to do so going forward. The recent sell-off highlights the risks of owning more speculative stocks, as these companies' prices were down in many cases much more significantly than the overall market. And our last two are, we still believe in having defense. Markets aren't as cheap as they were 5 years ago. Defense gives an investor an opportunity basket to sell and use proceeds to take advantage of low prices when the time comes. As opportunities present themselves, be prepared to reposition the portfolio, but don't move all at once. There still are many risks, and the environment has changed from the one that existed earlier in this market cycle. Prices could go lower, so patience and moving slowly may be a better approach. This wraps up our current market update. If you have any questions, contact us at 888-740-3501. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update early next year. Thank you.